How to invest in ETFs in Belgium in 2025. This is the full guide. Most Belgians are leaving thousands of euros on the table every single year. Why? Because they're still stuck in savings account or paying high fees in underperforming bank funds. In this episode, I'm showing you how to take control of your financial future by investing in global, low-cost index ETFs in a simple and effective way. It's simple because all you need is a couple of well-selected index ETFs, and then you invest in them each month in just a few clicks without the work and stress that stock picking or trading usually requires. It's effective because it's based on decades of academic research that proves that this approach provides better return than actively managed funds sold by banks while costing less in fees and taxes. In fact, investing well is far less complicated than what the industry wants you to believe. And it's this simple approach that I have used to build my 1 million euro portfolio and reach financial independence at 33. This is why I'm sharing the full process of how to invest well in index ETFs in Belgium in this episode. I also include a concrete example of a portfolio optimized for Belgian investors as illustration. That way you have everything you need to get started with just this episode. Here's what we cover. What is an ETF? Why invest in ETFs? 4 reasons. How to select an ETF. How to buy an ETF in Belgium. How much should I invest in ETFs? How often should I invest in ETFs? How to build your portfolio. A practical example of investing in a portfolio of ETFs optimized for Belgium. How to build wealth on Autopilot. How to get started faster without making the beginner's mistakes. Let's go. But what is an ETF? ETF stands for Exchange Traded Fund. It's a fund that is traded on the stock exchange. So it's a basket of investments like stocks and bonds that you can buy in just a few clicks with the brokerage account. Instead of picking individual companies and then stressing and hoping for the best, you buy a low-cost fund that simply tracks an index. For example, the FTSE Old World Index contains over 4,200 large and mid-sized companies across the entire globe, with both developed and emerging market countries. It's an index that covers the vast majority of the stock market in the world. So instead of spending all day doing research, analyzing financial reports, tracking metrics and performances, or trusting some self-proclaimed forecasting guru, you buy an entire market and simply get the returns of the entire market. And as we know from countless reports and academic research papers, investing in index funds delivers higher value to the investor than actively managed funds. Why invest in ETFs? 4 reasons. To put it simply, investing in index ETFs leads to better performance while paying less in fees, paying less in taxes than with bank funds, for example, and spending much less time compared to more active investing strategies. So when done right, you get better investment returns, save more money, and save a ton of time. It's really optimized for long-term performance and peace of mind. Index ETFs perform better than active strategies. This is the first reason. For the past 50 years, academics have known that actively managed funds underperform their benchmarks and an equivalent portfolio of index funds. This has been proven again and again, and I have a full video episode on that. And it's been proven in tons of academic research papers, as well as in regular industry reports, such as the Morningstar Active versus Passive Barometer, the SPIVA scorecards, and many others. On average, over a period of 10 to 20 years, over 90% of actively managed funds underperform a portfolio of equivalent index ETFs. So why pay expensive investment managers and banks for them to give you worse returns than the market? You paying them to give you performance, and the opposite happens. You're the one investing your money and taking the risks. They're the ones getting paid no matter what the market does. They get paid when the markets go up. They get paid when the markets go down. You take the risk, they get the money. It's just unfair. Investing in index ETFs is a no-brainer if you want to get the returns you deserve. The second reason is that index ETFs are generally much cheaper than investment funds offered by banks. based on a 2024 report by the FSMA, the Financial Securities and Markets Authority in Belgium. A typical bank fund costs 2.1% entry fees and 1.4% ongoing management fees. There is usually also a 1.32 transaction tax at the end. In comparison, a good ETF will have a transaction tax of 0.12% and an average management fee of 0.14%. This is 10 times cheaper than banks. And of course, it compounds year after year. So the longer you invest, the more cost-effective index ETFs are compared to bank funds. The third reason is tax efficiency in Belgium. Belgium is known to be a country with very high taxes. But when it comes to index investing, this is the complete opposite. We're one of the countries with the lowest investment taxes. There is no capital gain tax until the end of 2025. And just as I was about to release this episode, the government has just confirmed some details on the new tax on capital gains. So from the 1st of January 2026, there will be a 10% tax on the profits made from that date going forward. So all the past capital gains are exempt. This tax will only apply when you actually sell, and the first 10,000 euros of capital gains each year will be exempt from this tax. So while this new tax is quite annoying for index investors, it's actually fairly small still compared to most other countries in Europe. By comparison, the capital gain tax in France is 34%, in the Netherlands is 33%, and in Germany it's 26%. I will record an episode on this specific topic, of course, very soon, because it's an important topic for all index investors. On top of that, most stock market investments in Belgium are subject to a 1.32 transaction tax and 30% tax on dividends. But if you choose carefully, and this is something we're going to explain a bit later, you can invest in ETFs that reinvest the dividends so that you don't have to pay any tax on them, and for which the transaction tax is only 0.12%. This is 11 times less. The fourth reason is that index investing can be done in just a few clicks and takes just a few minutes each month. And in fact, with the development of automatic investment plans by Belgian brokers such as Bolero and Saxo, investing can be fully automated. Once you've developed your personal investment plan, you can set it up on Autopilot. I still recommend you take a minute each month to make sure that the investment is done according to your plan and the money actually gets invested. But otherwise, if you selected a broker that handles all Belgian taxes, then there's nothing to do. How to select an ETF? The choice of ETF depends on your preferences and needs, such as whether you want full global exposure or only developed markets, or whether you want to invest according to certain ethical principles or not. You also need to develop your asset allocation and include some form of fixed income in your portfolio. Later in the episode, I explain how to build your portfolio. But overall, my recommendation for most people is to select an ETF that is managed passively and tracks a global index, is globally diversified and tracks an index like the FTSE All World Index or an equivalent, has a low total expense ratio and a low tracking difference, that is already established. And so we like funds that are over 100 million euros in assets, that reinvest the dividends automatically. We call those accumulating or reinvesting ETFs, that is domiciled in Ireland, and that is registered in a country of the European Economic Area, but not in Belgium. The last three criteria is to minimize Belgian taxes. So if we go back to our example, and we want to invest in an ETF that tracks the FTSE All World Index that we discussed earlier, we could select, for example, Invesco FTSE All World UCITS ETF. It's an ETF that satisfies all the criteria we just listed. It has ISIN number, which is its unique identification number. That is IE 000716 YHJ7. And the ETF is available in Frankfurt, FWIA, and in Milan with the ticker symbol FWRA. This is a great ETF that regularly comes in our top 3 or top 5 best stock index ETFs for Belgian investors. How to buy an ETF in Belgium? In countries like the US, you can directly open an investment account with fund providers like Vanguard. In Belgium, we invest in ETFs via online low-cost brokers such as Bolero, Saxo, Keytrade, Rebel, and MeDirect. These are Belgian brokers that handle all Belgian taxes for you. There are, of course, also non-Belgian brokers, but those don't handle all taxes. And so I don't necessarily recommend them for beginners. Investing through a broker is not very complicated. When you need some specific knowledge related to index investing, it's essentially similar to buying sunglasses or any other product on Amazon. You open an account, then select the product you want. You check the brand, you check the supplier, you check the transaction or delivery fees, and then you confirm your order. But in fact, it's even better than Amazon because when the stock markets are open, the stock exchanges are open, then you get the transaction done right away and your product delivered right away to your account. For example, if you're an index investor based in Belgium, you can open an account with both Bolero and Saxo, try them out, and then go with the one you like the most. They're both excellent because they handle all Belgian taxes and have very low cost investment options. But how much should you invest in ETFs? This is a question I get quite often. And the short answer is that you can invest any money that you don't need in the short term, that is not in your emergency fund, and so that you're willing to invest for the long term, which is at least 5 to 10 years. You can start with very small amounts, like 5, 10 euros, because there are ETFs that are very cheap per unit. And also because some brokers offer fractional shares. But generally, it makes more sense to invest with larger sums. A good starting point is, for example, 100 euro per month, or 200, or 300. Basically, the more you can increase your contributions, the more you'll benefit from the compound growth of the stock market. At some point in my personal journey, when I was earning a lot of money and saving a lot of it because I wasn't spending much, I was investing 75% of my income. I was investing everything I was able to save beyond my emergency fund. That's what allowed me to reach financial independence at 33. But basically, invest what you can based on your possibilities. Make your savings work hard for you rather than keeping them on a savings account or in expensive bank funds. Let's take an example. In Belgium, according to recent statistics, most of the people who are able to save on average more than 350 euros per month. So we're going to use that number for our example going forward. And what's interesting with this number, 350 euro per month, is that if you invested in a globally diversified stock index ETF with an historical average return of 8.3%, and you invest month after month, you can reach a portfolio of 1 million euros in about 39 years. So the average Belgian saver is able to build a portfolio of 1 million euro. Most people think it's impossible, but it's just math. How often should you invest in ETFs? I say as soon as you have the money available. So as soon as you can. On average, the stock market goes up. So the sooner you invest, the more you can benefit from that growth. But you don't necessarily want to invest too often either, because more transaction means more fees. Sometimes it makes more sense to invest, instead of investing monthly, every 3 months, or every 2 months, or every 4 months. There's actually a really cool tool that allows people to calculate what's the optimal investment frequency to minimize fees while not losing too much of the growth. And I'm going to put the link in the description. It's called investcalc.github.io. Investing regularly is also called dollar cost averaging or euro cost averaging, where you buy for a similar amount of money each month, whatever the price of the ETF is. When it's expensive, you naturally buy fewer shares, and when it's cheap, you buy more of them. It's a simple strategy that allows you to invest regularly and benefit from the ups and downs of the markets without having to worry about what the markets are doing. And if investing regularly, regular amounts, then I recommend you consider setting up an automatic investment plan with one of the Belgian brokers that offers them at the moment, which are Saxo and Bolero. And if you have a lump sum to invest, so a larger amount that doesn't necessarily come from your monthly savings, you can either invest it all at once or spread it over time, over a period of, let's say, 4 to 6 months. Investing it all at once means that your money is invested earlier and has a probability of growing bigger and so for longer than if you spread it over time. But it's often hard for first-time investors to invest large sums because it's stressful to see that money go up and down with the markets. If you're stressed about what happens to your money right after you invest, then you can either split it up over time, or you need to reconsider your asset allocation, which is something that we're going to discuss right now. How to build your portfolio. When you start investing, you don't just buy the first ETF or the first stock that people are recommending online. It's important that you understand what you're doing, but that you also understand your own personal situation and your own personal needs, and then develop a strategy that is adapted to your situation and your needs. The main decision you have to make is how much equity and how much fixed income you're going to have in your portfolio. This is called your asset allocation. In fact, deciding on your asset allocation is probably the most important decision you have to make as an index investor. This is because it will determine the outcome of your investing far more than which broker you select and even which ETF you decide to invest in. This is because your asset allocation will determine the level of risk and volatility that you're exposed to, as well as the potential performance of your portfolio, and most importantly, your ability to remain calm when the markets are going crazy. Your asset allocation is what's going to protect you when the markets are crashing, having enough fixed income in your portfolio. If you have too much equity, you might panic when the market crash and panic sell. And if you have too much fixed income, then you might be giving up on too much potential profits. So the percentage of stocks, which is the equity, and bonds, which is the fixed income, in your portfolio will play a big role in your journey. A good starting point for a lot of people is to have 70% of their portfolio in stocks and 30% of their portfolio in bonds during the accumulation phase. So that is when they're able to save and invest when they're employed, and move to a portfolio of 50% stocks and 50% bonds when they are in the transition phase or in the withdrawal phase, which is usually retirement. So it's basically a bit more of an aggressive portfolio when you're working, saving, and investing, and something more defensive when you don't have that income and that you start relying on your portfolio. Once you decided on your asset allocation, then you can build your portfolio aligned with your asset allocation. And you buy one ETF with a globally diversified stock index ETF for the equity part of your portfolio, and then a high quality bond ETF for the fixed income part of your portfolio. And that's it. You only need 2 ETFs to build a really, really good portfolio. And once you've decided on your ETFs, asset allocation, your broker, and you understand how tax work and all that stuff, you can write it all down in your personal investment plan, which is your guiding document where you compile all the important information about your investment strategy and your portfolio. Let's now continue with our example. We can use the ETF we had discussed earlier, the Invesco FTSE All World ETF, to be part of our portfolio for the equity side of things. And to that, we can add a high quality, short-term Euro government bond ETF. For example, we can invest in the Amundi Prime Euro Government Bonds 0 to 1 year UCITS ETF. This bond ETF has a ISIN number that is LU2233156582. It's available in Frankfurt with the ticker symbol PRAB. So an example of a simple, optimized portfolio for investors in Belgium would be the combination of those 2 ETFs in, for example, proportions such as 70% the stock index ETF and 30% the bond index ETF. Now let's look at a practical example to invest in a simple and effective ETF portfolio optimized for Belgium. So once you've taken the previous steps that we just discussed and you've decided on your asset allocation, you've selected your ETF and you've opened your brokerage account, then you're ready to invest. You fund your broker account via bank transfer, and once the money arrives, you can then make your first transaction. To find the ETF on the brokerage platform, I recommend you use the ISIN number that is available for each specific ETF, and I have given them for the portfolio example that we're discussing. This is because the ISIN number ensures that you're buying the correct ETF. Then you select the amount of money you want to invest in that ETF, and you select the type of order. You can select market order or a limit order with a price that's slightly below what the current price of the ETF is, just to make sure that transaction goes through. Both of these approaches are completely fine in most cases. And then before you confirm, you will see a summary with all the transaction fees, including taxes and transaction costs. And if everything is good, then you can confirm. Generally, it's better to do those transactions when the stock exchange is open, so during opening hours, so that the transaction goes through right away and you don't have to worry about it and check it later to see if it went through. So going back to our example of the investor saving and investing 350 euro per month, this is split between two ETFs. 70% of these 350 euros will go into a stock index ETF and 30% into the bond index ETF, right? So for the stock part of the portfolio, we invest for up to 245 euro, which is 70% of the 350, into Invesco FTSE All World UCITS ETF. And as I am recording, the price for this ETF right now is 6.35 euros. And so with 245 euros, you can buy about 38 of them. And I will try to include a screenshot of what that looks like with the limit order on Saxo Bank. And it will look very similar with most other broker platforms as well. Then for the bond part of the portfolio, we invest for up to 105 euros because that's 30% of the 350 into Amundi Prime Euro Government Bonds 0 to 1 year UCITS ETF. And again, right now, one share of this ETF is worth about 21.24 euros. And so with 105 euros, we can buy about 5 of them. And again, I'm going to try to put a snapshot or a screenshot of that on the video for those of you who are watching the video. And then once you confirm those transactions, that's it. You're an index investor and it's time to celebrate. So how to build wealth on autopilot, which is the whole point of what I am teaching, is that you can develop your personal investment plan, implement it, automate it, or if you don't select an automatic investment plan, then you can invest in just a few minutes each month. And then you go back to whatever you enjoy doing in life. Because in fact, to me, money is a tool to live a better life. And investing is that tool just way more powerful because it makes money make more money. And so the whole point is not to spend 1 million hours on this, but to learn about investing, implement it in the right way, and then go and enjoy life. And of course, once your system is in place, you're going to have motivation to go earn more so you can save more and so you can invest more so that you can buy more time, build more financial security and more financial freedom. And if you're interested in joining a community of people who are on this path, I recommend you check the FIRE Belgium Facebook group, you check the FIRE Belgium website, you join our newsletter, and you watch and listen to this podcast and many more episodes where I share a lot more knowledge on similar topics. And if you want to take a shortcut and get started faster without making the beginner's mistake, I recommend you check the free workshop that I have recorded and that is available on our website, firebelgium.com. In this workshop, I dive deeper into all the concepts and strategies that we discussed today, and I share with you a specific roadmap so that you can learn everything you need to know to start investing with confidence, right? So it's basically what we discussed today, just more practical and with additional tools and support and resources for you to get started in the best possible way. It's a free workshop, so go check it out. It's on the website, firebelgium.com/investing workshop. I'll see you there. Cheers.